Hey, we're talking about the four pillars of investing today. I'm Matt Sumption, and I'm with Remax Equity. And thanks for watching. I think you're going to really like this. This is some awesome stuff. I love real estate, and this is one of the reasons because one, the government wants you to do it, and two, there's just so many ways to go about to invest in real estate. So, regardless, if you're starting out just now or you've been in it for many years, I think you're going to really enjoy understanding this, how this all comes, the four pillars, the pillars that make investing so lucrative and help us build our wealth. So with that said, we can jump right into it. I'm gonna share my screen with you and so you can see what I'm looking at. We have a little PowerPoint presentation to go over. Here we are. So, like I said, my name's Matt. I'm with Remax here in Provo. Let me know, as we're going through this information, feel free to reach out to me if you have a specific question about your situation that you'd like to go over. This is a very specific property that we've taken to help analyze, to give an example. You may be able to just take this and run with it, or you want to get into the details. Let me know. Here's my contact information. Happy to help. So to begin, disclaimer, please talk with your accountant. We've talked with the accountant to gather all this information and confirm that it is accurate and true. However, your situation is very specific to you and how you do your taxes. So take this and ask your accountant how it applies to your situation. So here's an overview of what the four pillars are. The first pillar here is cash flow, okay? And this basically, what we're doing here is taking the income, minus the expenses, that's your cash flow, and then we divide it by the money invested. Pillar number one, okay? We're gonna go in depth into each pillar. Pillar number two is interest. The government allows us to write off mortgage interest, okay? Pillar number three, depreciation. Over 27 and a half years, we're able to depreciate about 80% of the value of the property. And then pillar number four is appreciation. We're taking roughly 4% a year in appreciation, and then we also get to capture the equity that the tenant paid. So super cool. You know, I want to just go back real quick. I had something that I wanted to mention here about the four pillars of investing. Before we dive into it, I just want you to know Steve Bond coined this phrase, to my knowledge. If you don't know who Steve Bond is, basically just imagine James Bond, but as a real estate agent. Yeah, he's that cool. He's pretty cool. Maybe Google him, you can figure him out, research him. He's awesome. He's our broker here at Remax. And he just kind of brought this to our attention of how lucrative real estate investing can be. The other thing that I wanted to mention too was the reason why this is so lucrative, and one thing that I hope you get out of this is the government has incentives when we follow their rules. Maybe no one's ever told it to you this way, but consider the tax law that's in place here in the US. The tax law is instructions for us to do certain things. And there's a great book on this. If you want to read more about this, Tax-Free Wealth by Tom Wheelwright is an amazing book. Read that for more, but basically Tom talks about the instructions that we should follow if we want to obtain wealth. Some of those things are like providing jobs, starting our own businesses. The government allows us to write off business expenses directly from our income when we start our own businesses and create jobs. That's something you don't get if you're a W-2 employee working for someone else, right? It's not as lucrative on that. The government also wants us to manage and own real estate because they don't want to do it. And so they have a whole lot of tax deductions that they allow us to get when we buy real estate. For example, 1031 exchanges. When we buy and sell, when we sell a property and then exchange it for a like-kind property, we can go without paying the gains, right? The appreciation gains in that property. We're able to depreciate. We'll talk more about that here. We're also able to write off the interest. We'll talk more about that in here. But there are things that the government wants us to do, and if we follow those instructions, we become wealthy so much more quickly because it's just they're very they're awesome. They're really awesome. So I hope this kind of brings to the forefront us taking advantage of the taking advantage of the tax code in a good way. In fact, one of my favorite lines of the book that Tom Wheelwright that he wrote, he said, it's more patriotic to pay less taxes than it is to pay more taxes. That blew my mind. When I heard that, I was like, hold up, man, you've lost me, right? But it's so true. When we're paying less taxes ethically, right? When we're paying less taxes, that means we're following the code. We're following the instructions that the government has in place for us. When we're paying more taxes, we're going against the rules, the guidance, right, that they want. And yeah, kind of crazy, right? Kind of blew my mind. So yeah, let's follow instructions. Let's pay less taxes and let's do what the government wants to do. We become wealthy that way. Okay, so there's our overview. And let's dive into each pillar so we can better understand how each one is working and how they all come together. And I also want to mention, if you have a specific property in mind that you want to do this with, let me know. I'd love to do this with you, make it specific to a property that you have, okay? So there's a few assumptions. I just want to be clear on the assumptions that we're making. We have a specific property. It's an Edge Homes townhome in Vineyard. And the rent that we have for this particular townhome is $22.50 a month. And we're going to look at a pro forma together. I'm going to show you how we're coming up with this number. But regardless of this property or in the future, if you have another property, I like to use this website. It's called the Rentler, okay? And to my understanding, it's for the entire United States. And you can search active rental listings. And so in this area in Vineyard, this is where the townhome is. You can see all the rental prices. And they're hovering, most of them are just under $2,000, okay? Now there's this one, 2125, and it's 4-bedroom, 3.5 bath. The property that we're gonna be analyzing is going to be a 5-bedroom, 4.5 bath. And it's the same unit, we're just finishing the basement and we're including the cost of doing that in our pro forma to get a little bit more rent. So that's just so you know that. Okay, so feel free to use, and there's also Zillow and what was the other one? Oh, Facebook. Facebook has rental listings. Use these websites to make sure that you're calculating your rent about right. You're not too far above or below, so you get the right numbers. We're also assuming a conventional loan, 25% down payment, 30-year amortization, 4.5 interest rate, a credit score above 720, right? These are all things that you need to know for the loan aspect that could change depending on your situation. We're also not accounting for property management. This is a brand new construction townhome, so you likely won't have repairs. There might be some turnover in tenants, but you likely won't have to go in and fix things for several years. We're also assuming that you're in the 24% personal tax bracket. If you're not familiar with that, talk to your accountant or look at this. This will give you a brief idea. 24%. If you're married, filed jointly between 168 and 321 annual income. Okay. We also are considering that we should be collecting a pet fee. Usually, pet fees. I mean, everybody's kind of have their own opinion on this. Frankly, my opinion, I think having tenants have their pets is actually very profitable. It can be. You collect a deposit when they move in. If the carpets need to be more than cleaned, you can use that deposit to replace the carpet. Obviously, it could get worse, but the numbers do look pretty good with a pet fee, and that's what we're assuming in this scenario. And then, like I mentioned above, we're going to be making this a 5-bedroom, 4.5 bath by investing $10,000 upon purchase to do that. Okay. So let's go on to the next one. Here is the project. Okay. If you're familiar with Vineyard, the lake is right here on the side. So these are all beachfront properties. This is a really, really hot project and it's selling fast. They're already sold through 2/3. A lot of investors have liked buying these units, as well as just people to live. Vineyards happen in place. There's a lot of growth happening in this area. So, and let's go to their website real quick so you get an idea of what they look like. This is Edge's website, and you can look at floor plans and get more familiar with the location. But here's the outside image, right? Really nice construction. Got a great floor plan. You can even go here and begin a tour. You kind of walk around. Kind of gives you the dollhouse view. But anyways, feel free to take a look at that. So, and the other thing I want to mention too, the reason why we're making that 5th bedroom and extra bathroom downstairs is because the return is really good. If you invest $10,000 for an extra bedroom, we're estimating you could get roughly around $450 extra a month, which is an awesome return on $10,000 and overall unit. So that's what we're doing, and that's why we feel like we can get a little bit more than what's on Rentler, what we just looked at. In fact, I know people that are getting $2,650. I think that's probably the max. So $2,250 seems pretty reasonable. But you'll see here in a minute, even if you don't get $2,250, it's less. It's not making that big of a difference on the overall picture, right? And that's what I hope we start to understand is where's the real value of being invested in real estate? Why are we investing, or why are we not investing? Okay. If you want to know, I just have a note here. If you want to know more about Edge Homes, let me know. They have a lot of projects. They're one of the largest builders here in Utah. Be happy to share more information about them and see if one of the projects is going to make sense for you. Okay. Oh, the other thing too, parking is a big thing in Vineyard. That's one thing with the 5th unit. We want to try to get you next to, I think you can see my cursor here. Like one of these units off to the side where there's parking here. You do have a 2-car garage, so you could technically fit 4 cars in one of the units. And if you're next to one of these guest parking spaces, that's going to be easier for your tenants to be and more attractive when you have 5 in one unit. So keep that in mind. I know that's an issue in a lot of places. Okay, let's go on to the next. So let's evaluate the cash flow. Cash flow, the way we do this is we take the income, we minus the expenses, and then we get the cash flow. What are we left with after all the expenses are paid? Now let's look at, I have a pro forma here that I put together. We have the we'll just kind of go through so you have an idea of how we're putting our numbers together. Which, by the way, if you ever have a property that you want to have the numbers, to look at like this, I can spit a PDF out. And so just let me know. It's super easy. Makes it look really good. Square feet on this property, we're at 2,280. The purchase price we're looking at is 326,400. That's with a 4.5% interest rate, 25% down. That's what we're going to be left over with the first mortgage. The down payment, 25% down, is 81,600. The buying costs, I believe that's 2%, which basically is just getting the loan closed, right? The cost associated with getting the loan closed. And then the 10,000, that's for the improvement to get that extra bedroom and bathroom downstairs. So all in, you're just under 100,000 for this property. Okay. Gross rents, we're at that 2,250. The vacancy loss. Okay. So this is a number we're anticipating that 1 month out of the year, you're not going to be able to collect rent. There's going to be turnover. You're not going to collect rent for 1 month. We're including that in these numbers. Okay. Then you have your expenses. You take your operating income minus your expenses, insurance, repairs. This is just $50. I put $50 in there for just repairs that might come up each month. Taxes, HOA. That's going to cost you $354 a month to operate this property, which leaves you $1,716. And then you take your mortgage, you're left, after everything's said and done, you're left with $475 in your pocket each month, or annually $5,706. Okay, so that's the pro forma. This is a cash flow explanation of the property. How's the income and expenses working? So let's go back to this, right? Income, expenses, cash flow. So if we take our cash flow, that 5,706, and we divide that by the total money invested, the 98,128, that's going to give us a 5.8% cash on cash return. Now, one thing that I wanted to just explain a little more of, cash on cash is literally apples to apples to if you were to invest money in the stock market or if you invest money in real estate. What's the return going to be? Cash on cash is equivalent. Okay, so this is like you putting $100,000 in the stock market and getting 5.8% return just on cash flow. Okay, now the reason why you have to be specific on that is because you can use debt to buy real estate. You can't do that necessarily with stock. So it's a little bit different, and just want to make sure we're comparing apples to apples. So that's pillar number one. We have 5.8% cash on cash return on our 100 grand. Okay, so let's go pillar number two. We have the Carl's mortgage calculator. This is, I mean, there's a bunch of calculators out there, but it's just showing the interest paid each year, right? Interest, principal, and the balance of the payment on this property. The write-off and interest payment. Okay, this is really cool. So what's crazy is you get to write off the interest that's paid, and then keep the equity that the tenant pays for. You follow me? You got to write off the interest for the mortgage, and then keep the equity, the principal payment. That's so cool, right? You're not paying. That's not additional money out of your pocket. Your initial investment is your initial investment. You don't put any more money in other than that 100,000. You get to capture what the tenant is paying for. Pretty cool. So you take, to calculate this pillar number two, you take the interest paid, right? This 10,830. You times it by your tax bracket, the 24%, and now you're getting a tax savings of 2,599. If you take that tax savings and you divide it by your money invested, you're going to get a 2.6 cash on cash ROI for just owning the property and having a renter cash flowing in. Okay, so that's pillar number two. And when you add those together, you're an 8.4% ROI. Okay, so here's what we need to talk about. 8.4. Right now, with talking to investors, we're having the conversation right now. When an investor says, let's look at properties, it's usually, let's try to find something in that 6 cap. 7 cap would be awesome. Well, I think that's great, right? And we're not trying to turn a bad deal into a good deal by looking at these numbers. We're trying to just see the whole picture, right? If your investment philosophy is to get 7% return on your money, you buy this property because you're already getting an 8.4%. You follow me? Like this property, when you consider just 2 pillars, you're getting 8.4% cash on cash return on your money. And what I hope this does is I hope it helps us step back, look at a 100-foot view. When we're going to buy a property, what's the full ROI considered here? And I think too often we stop and just say, okay, what's the monthly income? What are the expenses? Oh, it's only a 5.8%. Yeah, we got to go find that 6, 6.5, 7. I'll buy it, right? So interesting, right? And we're only halfway there. So let's keep going. Depreciation. So depreciation, on average, typically we get to use 80% of the purchase price. So I just took 80%. That's going to give us $9,495 each year. And the government allows us to depreciate that over 27.5 years. Now, just as a little tip, ask your accountant about cost segregation. I'm not going to go into the details here, but it can be super powerful and it might save you a ton of money to do that. Your accountant will help you know if it's worth it. So we take that depreciation and we times it by a tax bracket again. That's going to give us another tax savings, $2,278. Okay. And if you divide that by your initial investment, that 98,128, that's going to give you 2.3 cash on cash return. Okay. This is money that you would have paid to the government, but you're no longer paying it because you own an investment property. That's what the government is saying. Buy investment property and you don't have to pay as much tax. Right. And this is, this is awesome. This is money that you would have paid to the government. Therefore, it is an ROI. It is a return on your investment because you would have had to spend that money. Cool? Okay, so that's pillar number 3. Now we're at 10.7% ROI. Woo! 10.7. And we got one more to go. Let's look at that. So the appreciation, I put the Carl's mortgage calculator because we want to include the principal, right? We got to capture that. But first, we're using 4%, right? Here in Utah, we've seen way more than 4%. But history has shown in real estate in the US, 4% a year is about average. Okay. So if you just take the average on the purchase price, the first year that you own this property, you're going to get $13,056 in appreciation. Plus, you get that tenant paid equity The principal payment that was paid down the first year, $4,054. You add those together, that's $17,110 in equity if you were to liquidate, right? After the first year. That you divide that by the total money invested, and that's giving you 17.4% cash on cash return. When we look at this, guys, check this out. When we look at this, it's a total of 28.1% ROI, cash on cash return for this property, right? On 100 grand. And where is the majority of that coming from? Pillar number 4, appreciation, right? We're being super conservative on this, right? And if you are like, well, you know, that cash flow, that seemed a little high, 22, like I don't really want to do that. Lower it, right? What would the difference of 1% make? Like if you were to rent that out for like $1,700, I bet you we're going to be like 1% less. That's okay. So 27%, you know, like it doesn't make that big of a difference. Pillar number 4, that's where we're getting our wealth from, the majority of our wealth. So as we look at that, I hope this helps you to see the 100-foot view of real estate investing and how it can be so lucrative, how it can help you. Now, some really cool things to consider is when you own more than one property, things get a little bit more complicated, but juicier. Gets really, really good because now you can start leveraging against those properties and playing with the numbers, and your accountant can help you do that. You want to make sure you have a really good real estate accountant that understands and frankly owns property themselves so they can do that. I personally like using John Harker. He's here in Provo and he's a great contact. If you have questions, reach out to John. He's really, really good at what he does. Okay. And the last things I'll leave you with, if this interests you, right? If this gets you excited, you kind of nerd like me, just kind of a goofball about these numbers and figuring out how to maximize investments, you'll also be interested to know that the 4 pillars of investing works amazing with accessory apartments. If you're going to buy a house with a basement to rent out or a duplex live on the other side, ooh, the numbers get sexier. Like it's really, really awesome. Accessory apartments. Okay. If you're a full-time real estate professional, the numbers get even better. It's amazing what the numbers start to do. You don't have to times your interest or your depreciation by your tax bracket. You get to use the whole number against your commissions that you're getting from your real estate, your full-time real estate profession. That gets good. And then syndications, you know, we were looking at this property and it was 100 grand that you needed as an initial investment. Maybe that's too much for you, right? Or maybe you don't want to put that much in one property. Syndicating is when you bring in multiple people to buy one project. Now there's been big syndications. 100,000 would be a very, very small syndication, or you could just do a partnership, right? Where maybe you bring 50,000 or, you know, 4 people with 25,000 and you own it together. You're still getting the same benefits, but with less money and frankly, less risk. So let me know if these things are of interest. We can talk about this and I would love to dive in and explain more about this. So with that, that is the 4 pillars of real estate investing. Once again, let me know if you have any questions. I'm here to help. I'm here in Provo. And thanks so much for watching.